Welcome to Market Crash Money. In this video, I wanted to take another look back in history, but this time at the crash of 1962, where I discovered a rare footage of young Warren Buffett making some comments in regards to the crash that took place in 1962. And in my opinion, what I heard is represented a striking similarity to the current market conditions. Here are the two reasons that Warren Buffett presents as the causes of the crash in 1962. Number one, of course, is the margin. And every crash that we have taken a look so far, this is the number one common cause. And with the sell-off that we have seen last week, March 19th through the 23rd, it's very interesting that if the market keeps falling again on Monday, the 26th of March 2018, then this situation could cause the markets to sell off even further. And the second reason he gives for the market crash in 1962 is the improperly secured bank loans. So let's take a closer look. I've actually presented this graph in some other videos, but it is striking. The level of margin debt, in other words, the money that people really don't have that they keep investing in the stock market and keep inflating these prices. In the event that the stock market continues falling next week, there's going to be a ton and ton of margin calls, which was actually part of the reason why the sell-off in 1987 crash intensified. So we're definitely in the danger zone here. The second reason, well, the Deutsche Bank disaster. The second reason that he presents as improperly secured loans, Deutsche Bank actually has 47 trillion in improperly secured loans. Why is this important? I've actually gone into a quite detail, breaking this down into the previous video named Market Crash Money Part 2. So if you're interested in details, please watch that video in its entirety. But briefly touching upon this, okay, Deutsche Bank, one of the largest financial institutions in the world, and its failure, which could be happening for a variety of reasons, okay, will affect the banks worldwide, including the banks here in the United States, such as Wells Fargo, Citigroup, Bank of America, Goldman Sachs, and so on. It will impact the banks in Asia. I was talking to a student from Australia earlier this morning, and he was saying how, you know, there's an investigation possibly looming on the CBA Bank, which is the largest bank in Australia, and it's got a very heavy exposure to Deutsche Bank as well. So there's a definite danger here as well. I present the graph of Deutsche Bank, which surprisingly, out of all the times, picked the last 3 days to fall. And the interesting thing that we're observing here is the way and the rate and the velocity of the fall each time it gapped down in the last 3 days consecutively. I actually compared this graph later with the graph of the fall of the Lehman Brothers in 2007-2008. If you look at the closing price of Deutsche Bank at 13.75 on March 23rd, the Friday of March 23rd, it could be compared to the closing price of Lehman Brothers in 2008, right before it completely collapsed to a near zero level. So to make this more interesting, Ray Dalio, which manages a $160 billion hedge fund in the United States, has been very successful at it. Pulls out a classic chess move, making it look like he was long the market, but he's actually been shorting European stocks to the extent of $22 billion. Now, where did this 1/3 of this bet go? Well, 33% of these bet apparently went towards betting against the German stocks, including Deutsche Bank, to a possible extent of $7.3 billion. So what do we have? Again, we have a possible situation where instead of Lehman Brothers, it's Deutsche Bank that's going to collapse and cause another financial crisis, which could be compared similar to the 2008, where the only problem is it could be worse. Now, of course, we're hearing great news, and the news analysts, they just don't give up, do they? When all the data points to all the negative things, they still stay optimistic. Well, I don't know how much longer they're going to be able to do it, right? Here's another title I picked up. I thought this was ridiculous and just absolutely crazy. The economy looks weak in the first quarter, but better days are coming. Look at these cheerleaders. My goodness. What makes this so incredibly bad is this. The economy is not growing after the trillions of dollars that were put in the American economy since the crash of 2008. Okay? To make the matters worse, the economy is not growing after the recent tax cuts. I mean, do you remember the news headlines how, the companies were paying out all of a sudden tons of bonuses to the employees, how they were raising their minimum wage from, $8 to $15, overnight. Now, given all that money injection in the economy by the Fed through monetary policy, through fiscal policy of cutting taxes, okay, the consumer is not spending, and this is why they keep doing these revisions. They completely revising the growth of the economy lower and lower while you keep seeing the headlines that, yeah, even though the economy is weak, okay, well, there's still better days coming. How they calculate that? They're not giving you any reasons. All we're seeing is the facts, and the facts are the economy is not growing no matter how you slice. Okay, so how bad will it get in the next 12 months as Federal Reserve is actually trying to unwind the quantitative easing that took place over the course of the last 8 years? Well, we just simply can't ignore. And, I don't know. The headlines are there everywhere. The signs are everywhere. So, should you keep ignoring the hundred thousands of jobs that are being lost? The retail apocalypse, okay? Not just the Toys R Us, but look, the institutions, the businesses that have been there for, 100 of years, 60 years, okay, that people are used to spending money at, okay, and you could say, well, yeah, it's the brick and mortar, it's the Amazon. Okay, well, how do you explain that Amazon is also cutting jobs and that Amazon is moving into the brick and mortar business at the same time as we're seeing many businesses are failing at it? So 50 more U.S. retailers filed for bankruptcy in 2018, so on and so on. Now we're talking about Sears going out of business, Vince Baby, Destination Maternity, and a bunch of other ones. The list goes on. Of course, you got the JCPenney, the Abercrombie and Fitch, the Guess, that, and we're not talking a small number of stores. Of course, 550 stores for Radio Shack, GameStop, 150 stores, American Apparel, 250 stores. Look at these numbers. We're not talking about just a couple of closures of these stores. So the economy is growing, but yet anywhere you look at, you have businesses closing down and jobs are being lost every day. And this is happening as the Federal Reserve is injecting trillions of dollars in the economy. So if they didn't do that, we would be in the 1929 1930s through the, 1940s sort of recession situation right now. Now, as bad as it seems with all these headlines and now for all these closures, okay, an interesting fact I was able to dig out is this. Companies from 1980 until 2017 reaching an all-time high of 82,000 companies in the fourth quarter of 1987 filing for bankruptcies. So if what we've been analyzing over the last few videos is actually going to materialize, which makes perfect sense, if the crash resembles the crash of 1987 over the course of the next month or two, we could be seeing a significant spike. So the list of store closures that we've been able to watch in 2017, 2018 so far is going to go up 4 or 5 times, because currently it's at about 23,000 companies in the United States are filing for bankruptcies. So that number could go, as the graph right here shows, clearly the highest number was at 82,000 set in 1987, right here, right after the crash. So we could be heading in that direction. And an interesting thing to point out, if you analyze the graphs, for those of you that might not, there's an interesting pattern called the double bottom. Just like we experienced in double top that I've described in some of my videos, where the market has tried to go higher and it failed multiple times. We'll call it station double top, after which it reverses and it falls lower. Okay, in this particular graph right here of United States bankruptcy, we're seeing a double bottom. Okay, and once it does, then the pattern, this is actually a bullish pattern of a reversal, which signified the fact that the bankruptcies, as they hit in their lows, they actually could be going significantly higher from here. So what do we make out of this? Well, I think the young Warren Buffett couldn't summarize it better. Maybe the market is correcting the previous incorrect forecast this time rather than making a new correct one. So take a look at this video.
I think the president's action on steel probably had something to do with the timing of the decline, but I don't think it was the factor which determined the amount of the decline. For some time, stocks have been rising at rather rapid rates. Corporate earnings have not been rising. Dividends have not been increasing, and it's not to be unexpected that perhaps a correction of some of those unusual factors on the upside might occur on the downside.
Well, some observers from time to time say that the stock market is a forecaster of events to come. Can you predict, or would you care to take a look at what you think this might be forecasting, the decline?
The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally. For example, the last 4 or 5 years, the stock market has been booming along and presumably forecasting better business, which has really not materialized. Corporate profits are not any better than they were 5 years ago, but stock prices are 50% higher thereabouts. So maybe the stock market is really correcting a previous incorrect forecast this time rather than making a new correct one.
Well, in a nutshell, Mr. Buffett, can you give us your opinion of just exactly what happened, what caused it?
Well, there was undoubtedly some forced selling the week when the stock market hit the news. The previous week, prices had declined about 6% for the week on average. And there was some stock that was forced upon the market both by margin calls from brokers and some that was forced out by improperly secured bank loans. And this in turn set up a self-generating mechanism on the downside for a while, which we may have seen the last of and which we may not have seen the last of.
So another interesting coincidence that I wanted to point out from this video. In the previous video, we were calculating the drop of the week March 19th through the 23rd, which I've calculated it to be at 5.5%. Did you just hear the last few words, how he stated before the crash in 1962 happened, it was preceded by a 6% drop in the markets just the week before. I thought I'd point that out real quick. If you're curious how to make money in this new market environment, please visit marketcrash.money. Find out why market crash 2018 is a possibility, what's going to happen to Bitcoin, how to profit, more importantly, how to take advantage of the stock market crash before it takes advantage of you. If you're looking for strategies, how to profit from the market fall, there's different ways to do it. If you have never done that, visit marketcrash.money, hit right here, how to profit, but schedule your consultation. Do not waste any time. The markets are moving fast. The opportunity of a lifetime is here. If you're a professional trader, if you're an experienced trader, been doing this for a while, but you're looking for specifics, in other words, which stocks do I buy put options on? Which stocks are going to outperform the market on the way lower? Schedule your consultation where I will share with you the file of how I personally turned, which is my record, $12,000 into $466,000 in trading options within a matter of 6 hours and 47 minutes. If you're interested, I will share it specifically, the strategy that I have used, which you could duplicate, that is based on a variety of factors. So it is a part of the consultation. Also, the consultation would be beneficial whether you're a short-term trader, day trader, whether you're a swing trader, or whether you're a long-term investor, because you can put option strategies on long-term perspectives as well, as far out as 1-year options, and in some cases even going out as far as 2 years. So if you're looking at opportunities, how to profit from the possible market crash, the time to act is now. Schedule a consultation. I look forward to talking to you soon. Thanks for watching. I'll catch you in the next video.